we've had a very good year, and it has been turbocharged by the coronavirus. During tough times, innovation takes off. It solves problems. Better, cheaper, faster, more productive, more creative products and services. And that is what has happened this year. Sheryl Sandberg said it really well on Facebook's earnings call last week. She said, you know, for the last 4 years, online has been gaining about 100 basis points of market share in the retail space in the US per year, 100 per year. In the second quarter, it gained 400 basis points. So 4 years in 1 quarter. That is what has happened here. And there's no turning back. Better, cheaper, faster, more creative. There's no turning back. And so we have tried to educate investors generally about the innovation that is taking off here. It's hitting exponential growth territory. We're talking about DNA sequencing, robotics, energy storage, so think electric vehicles. Artificial intelligence is blowing through every industry and should be blowing through every company if they want to remain competitive, and blockchain technology. Those are the 5 fundamental innovation platforms at work right now, and they involve 14 different technologies. The seeds for all of them were planted during the tech and telecom bubble. And investors back then were chasing the dream and took valuations to ridiculous levels. There was too much capital, chasing too few opportunities too soon. We needed the last 10 to 15 to 20 years of gestation for these exponential growth trends to take off. And costs are now low enough and the technologies are ready. If you look at a timeline of innovation, you'll see that you have to go back to the early 1900s to see 3 innovation platforms evolving at the same time: telephone, electricity, automobile. We have 5 now, and they're all growing at the same time with 14 different technologies that are going to transform the world completely. So this message has been resonating out there, and investors are attracted to this space generally. But there are some investors who really want nothing to do with it because of the tech and telecom bubble and maybe the 08-09 meltdown. They just want to stick with the basic benchmarks and play it safe. Well, if you look at the S&P 500, we believe that about 40% of it is in the process of being disintermediated, disrupted. The other side of disruptive innovation is creative destruction. That is going to occur, we believe, to roughly somewhere between 35 and 40% of the so-called safe index. And I know that a lot of value investors are seeing great opportunities out there. And the really good value investors I know are going to do spectacularly out of this period. But for those who are just focused on price to book value of 35 to 40% of the S&P is going to be written down significantly. Exxon just wrote down, poof, $30 billion last Friday. And we think that there are a number of areas, and we just put out a piece to help investors in these broad-based benchmarks understand what they are up against. The piece was called Bad Ideas. It mirrors our Big Ideas report that we put out every January. And we focused on 5 areas: banking, retail generally, television, linear television, rail, and traditional transportation. These are the 5 areas. These are all touching roughly 40% of the S&P, and they're all about to be disrupted. Banks by digital wallets, Venmo, so PayPal's Venmo, Square Cash's Cash App. Just take a look at what has happened in China with WeChat Pay and Alipay. That process is just beginning in the United States. I just mentioned what Sheryl Sandberg said about retail. The interesting thing about that 400 basis point increase in one quarter, it got us in the United States to 16% share of total retail sales going to the online world. The sweet spot of the S curve starts somewhere in that 10 to 15 high teens range of share. Then we go into overdrive. Then we go into overdrive in terms of new technology adoption. Think about it. Retail seems to have been destroyed already. We're only 16% into that move. Think about it. Linear TV, we believe that linear TV is about to experience a Wile E. Coyote moment. Off the cliff. Advertising spending on television in the United States has been fairly flat for the last few years, while the number of households watching TV has dropped from 100 million to fewer than 50 million. Think about that. And advertising has been flat. Well, streaming is about to solve that. There is a massive shift to streaming TV now. And we believe that the coronavirus tripped the switch for that television advertising to fall. And we think that analysts who've been fairly comfortable with the cash flows in that world are also going to experience the Wile E. Coyote moment. Rail, we think autonomous trucking is going to be cheaper than rail. That has never been the case. Trucks have always been at a disadvantage. In fact, with human drivers, they're 3 times more expensive than rails in terms of freight transportation. Autonomous trucking is going to change that, electric and autonomous. We believe that autonomous trucking will be cheaper than rail, going from 3 times as more expensive to cheaper. And then finally, traditional transportation. Again, this is not just rail. That analysis is all about freight miles. So it's about freight. Transportation is about people. Autonomous and electric is going to transform transportation globally during the next 5 to 10 years, disrupting energy, autos, insurance, ride hailing, car rentals. It's traditional transportation based on the internal combustion engine really hasn't been in exponential growth mode for 100 years when the autos were rolling off the first assembly lines. Now, with autonomous and electric, transportation is going to see exponential growth. Think electric vehicles for the first time in 100 years. It's going to be quite a shock to the system because our infrastructure has been built around the internal combustion engine, and that is about to end. Many people say that in our bad ideas report, we were taking a swipe at value investors. We were not. The great value investors know that their biggest risks are value traps caused primarily by innovation. We think there are 35 to 40% of the S&P will be considered a value trap over time, will be X growth, will be negative growth. And we think that innovation, staying on the right side of change, is going to be ever more important during the years ahead. We believe if you give us a 5-year time horizon, that ARK is a deep value manager. The difference between linear growth and exponential growth, when your time horizon moves from 1.5 years to 5 years, is night and day. And that's the arbitrage we are playing. We know that the great value investors understand how much book value is at risk out there. They also understand that high dividend yields are really in a bubble, I would say, high dividend yielding stocks, because of the search for yield out there. There's a desperate search for yield. And they also understand that they must consider intangible assets as well as fixed assets if they really want to understand who's going to win at this innovation game. So we embrace our value colleagues, and especially those who are alerting their clients that there is serious risk out there of disruptive innovation. And we'd love to debate some of our value colleagues anytime.
Hi, everyone. And now we're here with Rob Arnott, who is the founder and chairman of Research Affiliates, a legendary value fundamental focused investor. And he's going to talk a little bit about the value, the death of value or not the death of value, and sort of where we sit in the wake of the election. So Rob, I will turn it over to you.
Thank you very, very much. The much reported death of value investing is much exaggerated. It turns out what the growth crowd overlooks is that while value has underperformed growth by about 50 percentage points in the last 13 years, the biggest drawdown in relative performance, the longest drawdown in history in relative performance, is accompanied by about a 60% drop in relative cheapness of value relative to growth. For instance, if you use price to book value, the slump is 55% since mid 2007. And the price to book value of value stocks relative to growth stocks has fallen from 1/4 as expensive as growth stocks to 1/12 as expensive as growth stocks. That erosion is a drop of 2/3 in relative valuation. So what does all this mean? Suppose you have a stock that's fallen in value by half and its PE ratio has fallen by 2/3. Well, that means the earnings have grown and meanwhile the price has tumbled. Do you look at that and say, I can't stand the pain, get me out of here? Or do you look at that and say, I can't believe how cheap this is. I need to top up. And if I can possibly persuade my investors to buy, we're in the only major business in the global macroeconomy where customers hate bargains. Imagine Tiffany's puts up a banner sign saying post-COVID sale, everything marked up 20%. And people bash down the doors to get in. And Cartier across the street, banner sign, post-COVID sale, everything 20% off. And people shun Cartier because there's got to be something wrong with the product if they're discounting it. That's the way people in the investing world tend to think. And so when people say, I can't miss on the enormous opportunity represented by FANG type stocks and the tech sector, look how well they thrived and prospered during the COVID mess. Look how well positioned they are for the changes in human behavior that'll come after COVID is finished. I can't miss out on that. Well, the simple fact is that whole narrative is right, except for what are you paying for those companies? At its peak, Tesla was briefly worth more than twice as much as Toyota. Toyota makes 30 times as many cars as Tesla. Toyota has never had a losing year since the 1970s. And Toyota is priced very rich by automotive standards at $20,000 per car that they've produced in the last decade. $20,000 per car valuation for a company? That sounds pretty rich to me. What's Tesla's equivalent? It was at $500,000 per car they have ever produced. That is a big bet on their future growth. Do I think they're going to prosper as a business? Do I think they're going to grow into fields other than automotive? Of course. Are they going to be an important part of our future? I think so. But do I want to pay $500,000 per car they've ever produced to be part of that? No, I don't. So when you have value coming down and the relative cheapness of value coming down by more, it doesn't take much to get a huge snapback. We did some analysis recently in which we showed that if the relative cheapness of value goes back to historic norms, value beats growth by 7,000 basis points, 70 percentage points. Pretty cool. If it goes back to the midpoint of the cheapest decile in history, right now it's at the cheapest level in history, no exceptions, including peak of the tech bubble. But if it goes from cheapest ever to merely up to 95th percentile, that's a 3,700 basis point gain over growth. When we look back in history and find and ask the question, when value gets unusually cheap, how well does it perform? The linkage is really powerful. When value's fully priced, historic norms for price to book are 5-to-1 ratio growth versus value. When it gets up to 4-to-1 or richer, that is to say value more than 25% the valuation of growth, it's a coin toss. Value sometimes wins, sometimes loses. When it gets below 20%, meaning bigger than a 5-to-1 ratio, value has never failed to beat growth over the next 5 years and has won 97% of the time over the next 3 years. And that's true in the US, international, and emerging markets. Now, when it gets, we're down to 10-to-1 ratio, right now we're at a 12-to-1 ratio. When it gets down to a 10-to-1 ratio, on average, value beats growth by over 1,000 basis points per annum over the next 5 years. The actual experience is closer to 1,500 basis points a year. So when I look at that, does that give me a timing signal that you got to buy now because it's turning now? No, it does give me a valuation signal that you're going to regret, deeply regret, missing that train once it's left the station. So I look at the markets today and I think, I want to be a value investor. The election outcome doesn't make much of a difference. The Dems, I think, will be more friendly to social media because social media is more friendly to the Dems and Republicans less so. But if you have both parties thinking of revoking Section 230, which immunizes social media from litigation, from certain categories of litigation, well, that's actually a very interesting change that could take a big bite out of the valuation level of these companies. So who knows what the catalyst is going to be for the turn, but when the rubber band gets stretched this far, the chances of it stretching further diminish more and more, and the magnitude and speed of the snapback can be shocking. So bottom line is, I think that this is a better time to be a value investor than any other time in my career. Not on a past returns basis, on a future returns basis. I look back on the tech bubble and I thought I would never see valuations stretch the way they were there. We're back to that and then some.